Hi, everyone. It's the Catholic CEO, Henry Katarna. Welcome to our Catholic Business Wisdom series, which is an MBA in a box. And today's topic is the trust. We have been talking about different financial mechanisms and corporate mechanisms to do business. The trust is something that you've probably heard about. You've probably heard about family trusts or trusts that are used to handle estates or large fortunes or even small fortunes and family wealth, family funds that are intended to be set out for different uses, for different people, for beneficiaries, and for the future. So a trust is a legally binding agreement. It's a contract, and it's a complicated contract in the sense that today's short view of the topic is not intended to be an advice to you. Really, you should find professionals that know a lot about the trust and can actually handle the legal and the financial implications, the taxation implications of them. But simply put, for our purposes today, a trust is a legally binding agreement to establish who will receive portions of your wealth when you die. And that means that there are conditions on how that wealth transfers to people. You've seen trusts where there's an age factor. Somebody doesn't get their inheritance until they're 25 or 40 or 50 or something like that. Or they get their inheritance if they're married and have children, or if they have gainfully occupied themselves and they're not in trouble in any way with the law or things like that. So trusts can be wide-ranging in their application, but the point is they are binding agreements to establish who's going to receive portions of your wealth when you die, under what conditions. They are designed to be tax effective, tax efficient, in the sense that they are ways to not only minimize tax, but to postpone tax. That's where the complexity comes in. Knowledge of the tax law and of legal mechanisms is really important when you set up a trust. A trust is often associated with billionaire, large families, large wealth accumulated families, or generations of a family. For example, 2 or 3 or 4 generations of a family are often bound together in a trust like this. You've heard of living trusts where conditions could change. Trusts are revocable in the sense that they can be changed, or sometimes they're irrevocable. Once they're set up, they're irrevocable. You cannot change them, you cannot modify them. And so you can see the consequences of a trust are very powerful. If they're revocable, well, certainly you could make some changes to them, succeeding generations, or even the same person who is setting up the trust could make some changes to it. If it's irrevocable, then it's final, and there's no changing it there's no changing it if it's an irrevocable trust, because the person who sets up the trust signs away their right, to make any changes. Here are a couple of pros and cons of a trust. So it's a special mechanism. It's a way of you handling your wealth on a tax-effective way and getting it to your beneficiaries under certain conditions and under conditions that are tax-advantaged or are helpful to you in managing your wealth. For example, if you have a large family with thousands of rental properties, as an example, they might create a family trust that says that the rental units can never be sold or broken up. The empire must kind of stay together so that the financial impact is powerful. So here are some pros and cons. First, let me talk about some pros. One thing that can happen with a trust is that you can avoid probate. Now, probate, again, a technical term. When somebody dies and they have a will, they have an executor, and that executor carries out the provisions of the will. They have a legal responsibility to do so. Probate is the legal process that observes how the will is administered by the executor for the beneficiaries. And probate is a legal process in which there's an oversight, a review of the will. It costs money. If you put assets through, let's say, millions of dollars of different properties or hundreds of real estate condo properties through probate, you're going to pay a fee for those. And so sometimes people avoid probate by setting up a trust. And so it doesn't have to go through probate because it goes through the alternate or another legally binding agreement called a trust. Second advantage of a trust is tax avoidance. Now, remember, tax avoidance is legal and it's even morally correct. Tax evasion, where you cheat and lie, of course, is not morally correct. So let's just be clear on that one. So tax avoidance, obviously, if you have a number of properties and you die, your properties may have to be sold so that your beneficiaries can get the money. And what happens in a trust sometimes is there's tax avoidance because the properties aren't sold, or the properties may be sold, but the funds may be retained inside of the trust, perhaps on a tax-free basis. No guarantee of that. You'd have to check it out. But one example is it could be kept inside of the trust on a tax-free basis, and then the interest or the investment returns from those funds could be distributed to the beneficiaries. So you can see a trust has power and authority to yield certain results. It's almost like the same process that goes on in your will, but it's far more complicated, and it has the power of a contract under the law. Number 3, for the, let's call it the pros, the advantages of a trust, it's private. So some trusts, most trusts, are hidden from the public. So the terms are available only to the beneficiaries or the people who are going to participate in the administration of the trust. And therefore, there's a guarantee of privacy. So some of the large families that own some of the largest corporations in America or in Europe or in Canada will enter into a trust arrangement so that they can keep it all private. And so nobody knows which kid is getting which, assets, or which house, or which motor launch, or, yacht, or something like that. And so while it may sound a little, prurient, so to say, you can understand sometimes the need for families to have privacy because the prying eyes of the public and the paparazzi are often interested. Even in a small trust where there's only a limited number of properties or a limited number of assets, sometimes people don't want it to be known where the investments lie, with which companies, where shareholdings are held. And so you can see that privacy is utmost here. Another advantage of a trust is flexibility. Obviously you can make changes to a trust, you can do certain things, you can give different conditions for different beneficiaries, you can treat different asset classes within your trust differently. It can get quite complicated, but be assured that one of the reasons people go into a trust and create these things is that it's flexible. Now, another one, a fifth advantage would be what I call income splitting. And so let's say somebody dies and there's a widow, and let's say there's children. So sometimes the person who dies wants the widow to maybe receive most of the income from the trust. While she's alive, her needs can be taken care of, and perhaps the children are given a smaller amounts. But upon the demise, the death of the widow, then subsequently, eventually, maybe the income then increases for the remaining beneficiaries. Or maybe certain beneficiaries are underage and therefore there's an allowance made for them, but they're not getting control of the assets, and so on. So income splitting and other tax strategies are also one of the advantages of a trust. The disadvantages of a trust, let's call it not necessarily the negatives, but let's say the realistic costs of doing a trust. A couple of them. One is certainly the cost. These things are more expensive than you writing out a holograph will in your own handwriting, or going down to the local Office Depot and getting, a template of a will and then filling it out and signing it and letting it have the force of legal rights and legal arrangements. Cost. A trust is, there are lawyers, there are tax experts, perhaps tax lawyers, and there are other financial advisors, including your accounting staff, your accounting team, all of whom are brought into the discussions to check whether the decisions made in the trust are tax advantaged, or that they are able to withstand the long reach of the tax man, so to speak. And certainly a trust can be taxed at a higher rate depending on some of the circumstances. Taxation can be avoided or it can be delayed, but generally speaking, I think a trust, it could be argued, is going to result in some sort of tax provision, often higher. It's not, you'd have to be talking about specific examples, but there's a tax consequence to a trust. And there's certainly paperwork. If you have to have a trust administered, and let's say there are 5 or 10 beneficiaries in a family, and there are numerous classes of assets and maybe holdings all over the world or in different jurisdictions, different countries, different states, different provinces, the amount of paperwork is much multiplied. If you have a simple will and you die and you dispose of your assets after paying all your just debts, well, you're going to have some paperwork, yes, and you're going to have to file the final tax return, the immediate return upon the death of the person, and then subsequent to that, the final estate tax return. Yes, paperwork involved, but with a trust, there's ongoing paperwork. So every year there's filings, there's reporting, there's analysis, there's information exchange, information flow, and then of course there's reporting and there's tax consequences. And this can go on for years, decades, and it can go on for generations as well. So there's a whole industry, and I'm not negative on this, but there is a whole industry devoted to servicing the trust. And so as a method of financing, it's not going to be your typical mechanism, but it's important that you are aware of, how these things work. A trustee generally is the manager of the assets of a trust. It's called a trustee. And the person who establishes the trust is called the grantor or the settler of the trust. These are technical terms that go back in history. But remember that there's a person who establishes the trust, and then there's somebody who manages the trust for that person. And it's usually the trustee who is the administrator or the manager. Then there is a beneficiary, and a beneficiary can be people, individuals, can be organizations, it can be companies, it can be anybody. A will can also bypass probate. We talked probate a few minutes ago, in the sense that if you're clever and prudent, one quick example is if you have a home and you have rental properties, you can sometimes avoid probate even in a will, never mind a trust, but even in a will, by creating a joint ownership situation where you put your beneficiaries' names on the title with you. And so then when you die, the property, the house, transfers to your children immediately with no probate fees. So that could go for your principal residence. Let's say you have a family home, you die, you're the last owner to die, but you have your children on title. That property transfers tax-free because it's your residence, but also probate fee-free because it's transferred outside of probate, inside of the will. And so trust can bypass probate, not always, but a trust can bypass probate. So this is a very simple review of what the trust is. It's a highly complicated topic. I need you to make sure you get proper advice on this. But generally speaking, the value of a trust is that it can set conditions and terms on an ongoing basis for your beneficiaries if you have particularly a complex array of assets or in multiple jurisdictions, or dynamic assets that are operating companies and businesses where professional management is required. There you go. The trust, it's an interesting mechanism. It's a powerful mechanism, and it's complicated, and it requires careful attention and prudent thought. So thanks again for joining us for the Catholic Business Wisdom series. This is the Catholic CEO, Henry Katarna. We'll see you next time.